All right. Going to be going live soon. Very soon. And I'm not sure exactly how we're going to do this. But we'll figure it out. I will figure this out. So, the key being the microphone needs to stay about right there. And hopefully the audio quality will be good. And we'll start recording here momentarily after I set up a few more things. Okay. A little bit lower now. A little bit lower now. Maybe just a smidge higher. Better. Okay. All right, about 30 seconds for the changes to take effect. It's fine, okay. I'm not really going to be checking in on the viewers. One last thing. I'm going to add a new capture. All right. So here we go. So guys, before I click start recording, I just want y'all to know on this live stream, there will be me like repeating lots of things. I will be going over stuff over and over again, especially if I like stumble over my words, but I'm going to be recording this so that I may edit it into the videos that you guys see on the channel later. So let me get a little bit more in position. I guess this is probably the best because There we go. That's probably a little bit better. Just a tiddly bit. Okay. So I'm going to go ahead and start recording and do my introduction to the book. Hey, everyone. Hello, everybody. My name's Dave. I don't have a great introduction, so we'll just be cutting some of that out, right? I can't be doing these recordings if there's a lot of this jumpiness. Okay. We're going to be reading from the Alchemy of Finance. We're going to be taking a look at all of my tabs, all of my highlights, and basically diving into what good old George Soros has to say. Some of the things that I found kind of interesting, kind of peculiar, and just overall helpful for, well, what it is for investing, for the markets, for the economy, and for the world. So without further ado, we're going to dive right on in to my first tab, where on the very first page I've got in the forward to the new edition, my first highlight, and I believe it's Paul Volcker writing the forward here. Paul Volcker writing the forward. George announced at the start that the concept of equilibrium has no relevance to the way financial markets operate. Thinking in those terms would be counterproductive in terms of trading success. Markets react to participants' expectations. They're unpredictable in reality. I also have difficulty at times in following the subtleties of George Soros' mind as he elaborates his concept of reflexivity. Anyone familiar with asset markets knows that it is expectations that move prices. Soros goes beyond that observation to emphasize that expectations cannot and will not arrive at a stable equilibrium precisely because the thinking and therefore the actions of market participants will affect market behavior. The market will in turn influence the fundamentals and shape new expectations in a continuing reflexive process. Thinking is part of the reality that people have to think about. So I think that was a very important insight and reflection by Volcker, because what we saw with GameStop, what we've seen post 2020, is this reflexive process. Fundamentals don't matter anymore. Technical analysis doesn't really matter anymore. You can basically get lucky, but I don't think the markets still are a gamble. I just think that when people think a stock is going to go up because a company is doing good, then therefore it will go up. Right. And not investment advice, not financial advice, just mentioning GameStop as a historical example of something that happened in 2020. For now, one thing seems to me certain. Volcker continues. He's saying that Soros has, from his unique perspective, brought a clarity to deep-seated problems of international finance that have been too little recognized in either the world of academia or that of policymakers. He closes his foreword with, "What remains is what George or any of us can do to build new theories and new policies approaches that better what remains is what George or any of us can do to build new theories and new policy approaches that better reflect the reality he describes." My first highlight from Paul Tudor Jones II in the foreword to the first edition is he's talking about George's investing record is the most unimpeachable refutation of the random walk hypothesis ever, right? So I highlighted that because of Random Walk Down Wall Street, a book that I own but have never read, because everyone told me to read it, being a contrarian and noticing that didn't quite think it was true. And I noticed something else, and that just really confirmed it for me, saying like, okay, there is a different path. There is a different way to approach this than what the industry wants you to believe. Mr. Soros's theory, hold on, let me get some context. Something about the takeover of Nabisco in 1989. Mr. Soros's theory of reflexivity is the first modern, non-technical effort to describe the forecast, the dynamic interplay between the participants in the process. That is the brilliance of this book. It describes the dynamics of the path between points of extreme valuation and equilibrium in the marketplace. This is particularly important for the average investor. Winning is infectious, and this book is replete with examples of trading behaviors all would want to emulate. And I think a lot of it is true. I think reading this book is going to help you be a better trader, and I would highly recommend picking it up. I would highly recommend picking it up and actually reading it for yourselves, because I'm going to just be doing my highlights, right? My little quick tabs, my quick notes, but not actually going into too much detail. Oops, one of my tabs fell off. Not a big problem. All right. And then George Soros wrote a new preface, which I will read the highlights. The second paragraph towards the bottom, he says, the prevailing view remains that leaving financial markets to their own devices will assure the optimum allocation of resources. After 15 years in print, there is some merit in exposing it to the test of time. I believe that his book, The Alchemy of Finance, passes the test quite well. The new introduction is rather dense, but that cannot be helped because it deals with highly abstract philosophical views. My goal is very ambitious. I seek to lay the groundwork for a new paradigm that is applicable not only to the financial markets, but here's where it gets interesting. He closes with, but to all social phenomenon. All right, wrapping up his new preface. I lay the groundwork for a new paradigm based on the recognition that our understanding never corresponds to reality. I found that insightful. And the divergence, which varies from person to person and case to case. Everybody is unique. We know this from psychology. We know that everyone has a brain that is like a fingerprint. We know that from John Rady and Katherine Johnson's book called Shadow Syndrome. The implications of this paradigm reach far beyond the financial markets. In the book, I conducted a real-time experiment that gave a blow-by-blow account of my investment decisions over a period of time, but I did not delve into my own decision-making process. On this occasion, I shall make an attempt to reveal the secret of my success. So he does want to expose to us what his secret of success is. Okay, so now we're getting to the new introduction, which this is where I have tons and tons of highlights. So we're going to dive in and we'll edit out what we need to edit out in the video later. The new introduction starts with a critique. The new introduction starts with a critique of the prevailing paradigm. Although my sphere of activities has expanded from the financial to the social and political, I apply the same conceptual framework to those fields as I do to the financial markets. Understanding reality in financial markets in particular is a never-ending process. First, I must specify what the subject is. The book is about financial markets, but my life's work is not confined to that arena. I was interested in philosophy long before I became engaged in financial markets. As I wrote in the original introduction, the abstract came first. Ever since I became conscious of my existence, I have had a passionate interest in understanding it, and I regarded my own understanding as the central problem that needed to be understood. I developed a theoretical framework based on the concept of reflexivity to explain the relationship between thinking and reality, and I used the financial markets as a laboratory to test my theory. He says, more recently, I've become preoccupied with the problems of globalization. However, I feel obliged to restate the conceptual framework. The concept of reflexivity. It's very simple. Situations have thinking participants. There's a two-way interaction between the participants' thinking and the situation in which they're participating in. On the one hand, the participants seek to understand reality, and on the other, they seek to bring about a desired outcome. The two functions work in opposite directions. The two functions can interfere with each other by rendering what is supposed to be given contingent. I call the interference between the two functions reflexivity, and the two functions is The cognitive function, reality, is the given, and the participating function, the participant's understanding, is the constant. So there's a given and a constant. I envision a reflexivity feedback loop, he goes on to say, between the participant's understanding and the situation in which they participate, and I contend that the concept of reflexivity is crucial to understanding situations that have thinking participants. Reflexivity renders the participants' understanding imperfect and ensures that their actions will have unintended consequences. The way our senses work, the way our language is structured, and many other factors combine to render our understanding imperfect. But the imperfection introduced by reflexivity is more specific and needs further elucidation. The imperfection I am concerned with arises because we are participants. When we act outside as observers, we make statements that do or do not correspond with the facts without altering the means that do or do not correspond with the facts. Crap. When we act outside as observers, we can make statements that do or do not correspond to the facts without altering the facts. When we act as participants, our actions alter the situation we seek to understand. As a consequence, we cannot base our decisions on knowledge. We may know many things, and the more we know, the better we are placed to make the right decisions. But knowledge alone is not a sufficient basis for making decisions. If the participants' views correspond to the situation would not be unknowable, and participants could act on the basis of knowledge. But that is not the case. If it seems like circular logic, well, it is. A circular feedback he has called reflexivity. Next is a section on reflexivity and economic theory. My main excerpts and highlights in this section are going to be the Alchemy of Finance was meant to be a frontal assault on the prevailing paradigm. I find it so, and I think that's why it's an important read. As a practitioner, I felt I was better off without them, such as the theory of efficient markets and rational expectations. Nevertheless, the theory of reflexivity has gained ground among practitioners. Let me first dispose of the theory of rational expectations. The theory, as I understand it, Soros asserts, that market participants, in pursuing their self-interest, base their decisions on the assumption that other participants will do the same. This sounds reasonable, but it isn't, he says, because participants act not on the basis of their best interests, but on their perception of what their best interests actually are. So very interesting, right? Because who is telling you what your best interests are? Is it your spouse? Is it the government? Is it your education? So knowing that, or is it your financial advisor, for instance, who, may be a part of, like, where did that person's training come from? So I thought that was interesting that George Soros does challenge the paradigm of the efficient market hypothesis in that way and rational expectations. Further on in the book, after skipping a few lines and paragraphs, I highlighted, I work with a different model, and the fact that I have been successful using it as a market participant makes nonsense out of rational expectations. I contend, George Soros continues, that financial markets are always wrong in the sense that they operate with a prevailing bias. But the bias can actually validate itself by influencing not only market prices, but also the so-called fundamentals that market prices are supposed to reflect. That is the point that people steeped in the prevailing paradigm have such difficulty grasping. Beyond a certain point, the self-validating feedback loops become unsustainable. That is how reflexivity gives rise to initially self-fulfilling but eventually self-defeating prophecies and processes. The most spectacular manifestation is in the boom-bust sequences that are characteristic of financial markets. The theory of reflexivity can explain such bubbles, while the efficient market hypothesis cannot. We can see then that the efficient market hypothesis and the theory of reflexivity are alternate theories about the behavior of financial markets. The efficient market hypothesis does not fit the facts, and it is also questionable on theoretical grounds. The illusion that markets are always right is created by the reflexive interaction between the participating and cognitive functions. In fact, markets are almost always wrong, but their bias is validated during both the self-fulfilling and the self-defeating phases of boom-bust sequences. It is an interesting question, he continues on the next page, why such an unrealistic interpretation of financial markets as the efficient market hypothesis should have gained such widespread acceptance. The answer is to be found in the requirements of economic theory as a scientific pursuit. Okay, this is where I feel like he has a lot of credibility in this statement. Like, this is very true. Like, you can't say and put, like, you can't compare apples to oranges. Yes, they're academic pursuits, but like saying that the economy and people are as predictable as the scientific method and in like the scientific academia, it doesn't quite work. So let's dive into why he says that. Scientific theories are supposed to have some predictive value, and the efficient market hypothesis seeks to meet that requirement, while the theory of reflexivity does not. On the contrary, it contends that the course of events is inherently unpredictable. Thus, the former qualifies as a scientific theory, albeit a false one, while the latter does not. I have acknowledged this fact by entitling my book The Alchemy of Finance as distinct from science. It's kind of coy, kind of cute, right? Like the alchemy of finance. Alchemy is kind of like a dismissed science, and so he's kind of dismissing modern day economics as alchemy and saying like this is kind of more true. This is actually more how the financial markets actually are. They're more reflexive. They can't really be predicted. You can have all you want to. You can try to make it as scientific as possible, but the truth is people think they know and they make predictions and then they act in accordance to that thinking and those predictions. The human uncertainty principle. We live in the real world, but our view of the world does not correspond to the real world. Yet our view of the world is part of the real world. We are participants. And the gap between reality and our interpretation of it introduces an element of uncertainty into the real world. Again, this sounds like circular reasoning, but it accurately describes situations with thinking participants. What he calls the human uncertainty principle, that principle holds that people's understanding of the world in which they live cannot correspond to the facts and be complete and coherent at the same time. Insofar as people's thinking is confined to the facts, it is not sufficient to reach decisions, and insofar as it serves as the basis of decisions, it cannot be confined to the facts. The human uncertainty principle bears a strong resemblance to Heisenberg's uncertainty principle, which holds that the position and momentum of quantum particles cannot be measured at the same time. But there is an important difference. Heisenberg's uncertainty principle does not influence the behavior of quantum particles one iota. They would behave the same way if the principle had never been discovered. The same is not true of the human uncertainty principle. Theories about human behavior can and do influence human behavior. Marxism had a tremendous impact on history, and market fundamentalism is having a similar influence today. A phrase like the axis of evil can alter the course of history, and calling the estate tax the death tax can alter the course, can influence public policy. My own actions and my performance in the financial markets would have been different if they had not been based on the human uncertainty principle, although I had not yet given it a name at that time. We may speak of imperfect understanding, but it may be more appropriate to speak of human creativity. Imperfect understanding has a negative sound. Creativity is more inspiring. If perfect understanding were possible, there would be no room for creativity. As it is, the world in which we live is, to some extent, our own creation. The extent to which people's thinking shapes reality requires further examination. Reality is more complicated. To understand it properly, we must reality is more complicated. To understand it properly, we must distinguish between natural phenomena that are impervious to what people think and social phenomena that contain thinking participants. As we have seen, people base their actions not on reality, but on their view of the world, and the two are not identical. Social situations like revolutions or political compromises have different meanings for different participants, and even after the event, they are subject to different interpretations. He has a citation for that. It's in the back of the book. Myths about the past have a bearing on the future. He references the Battle of Kosovo in 1389 and the breakup of Yugoslavia. This poses problems for scientific method, but at the same time renders scientific knowledge less important in the understanding and shaping of human affairs. History is a story, and there is plenty of room for magic, superstition, religion, and other beliefs. I didn't highlight anything in the last paragraph. Next, he introduces Karl Popper, one of the gentlemen who has greatly influenced his thinking and the way that he came up with this theory in a section called Social versus Natural Science. My first highlight after he introduces Karl Popper as one of his great influences reads, first, reflexivity and the human uncertainty principle interfere with the predictability of human behavior. Second, theories about human behavior can and do influence human behavior. So I think that's probably the most important aspect of reflexivity that you need to understand as he goes through this, as he's talking about this, is that human behavior and our understanding of human behavior is the biggest influence on human behavior, because if we think we understand how we behave, then we might alter how we behave based on how we think about how we behave. And that is going to be a similar circular logic of how we act when we invest and try to understand the world around us. Today's ideology of market fundamentalism was known as laissez-faire in the 19th century. It is once again very influential by virtue of its influence on the policies of the United States and the so-called Washington Consensus. Its dominance cannot be compared with the paramount position that Marxism used to enjoy in the Soviet Union, because the US is a democratic country, but the two ideologies have one feature in common. They both base their claim to validity on the authority of science. Without holding economic theory responsible for the sins of market fundamentalism, I must contest that claim. Soros wraps up this section with this paragraph. I consider market fundamentalism a dangerous ideology, more dangerous today than Marxism, because Marxism has been discredited, while market fundamentalism is the ideology that underlines the globalization of financial markets. I have been at pains to point out the excesses and deficiency of globalization, but every time I criticize market fundamentalism, I have to go through the argument that I have presented here to show that financial markets do not tend towards a rational expectations equilibrium. That would not be necessary if the implications of reflexivity and the principle of human uncertainty were generally accepted. He talks about the grand pattern of credit and regulatory cycles. He looked for this pattern, something about weakening his argument in boom bust model. Under his section of power, he read Mancur Olson's Power and Prosperity and says that he did not give sufficient weight to power relations. He talks about the Sarbanes-Oxley Act, the Chemical Bank, Saul Steinberg, and then goes on to write, the neglect of power relations is especially noticeable when the book deals with the evolution of the global financial system. It is inherent disparity between center and periphery. The center consists of countries that can borrow in financial markets in their own currencies. The periphery is constituted by those countries that cannot. The disparity arises because the countries at the center control the international financial institutions. When threatened by a recession, they themselves can follow countercyclical policies. The primary interest of the IMF is to protect the system. The globalization of financial markets was a market fundamentalist project. Its aim was to constrain the ability of national governments to interfere in the economy by making it easy for financial capital to move around internationally and making it difficult for national governments to tax it and regulate it. Financial capital is an essential ingredient of production, and it will seek to go where it is best rewarded. National governments must therefore compete to attract and retain international capital. As a market fundamentalist project, globalization has been highly successful. The taxation and regulation of financial assets have, in fact, been greatly reduced, and the return on capital has been significantly increased. On the next page, I have one highlight, a a part of a paragraph. Market fundamentalists insinuate that markets have a moral quality about them by allowing the diligent and creative participants to come out ahead. This argument always suffered from neglecting the social injustice of unequal initial endowments, but it is entirely destroyed if financial markets do not merely permit free exchange but promote the dominance of the powerful. As I have pointed out elsewhere, and he has a citation for that, so you can go back to number 5 in the back and figure out where he pointed this out. The distinguishing feature of financial markets is that they are amoral. That is one of the factors that make them so efficient. Market fundamentalism is a convenient ideology for the rich and the powerful. In the markets, the struggle is among individuals. This is his closing paragraph. In the markets, the struggle is among individuals and enterprises. In geopolitics, it is among states. This is a distorted view of the world. It emphasizes competition to the exclusion of cooperation. Yet, without cooperation, there would be no laws, no markets, and no civilization. Until recently, I was inveighing against market fundamentalism, which I considered a greater current threat than Marxism. Now, I regard the ideologues of American supremacy as even more dangerous than market fundamentalists. What I am afraid of is that the pursuit of American supremacy may be successful for a while because the United States, in fact, enjoys a dominant position in the world today. However, it will fail in the long run because the concept is flawed. If the Bush Doctrine passes some early tests successfully, it may give rise to a boom-bust process with much more devastating consequences than a purely financial crash. I starred that section just because it does elucidate how he thinks about the United States and the system. Okay, he talks about there's dichotomies, the negative in a section called a negative approach. And that the first iteration of the book had a lot of negative terms. There is an element of intuition or invention in the formulation of hypotheses. Statements can only reflect or fail to reflect the facts. They cannot affect them. So there is something good about trying to create a hypothesis around something you believe, because you're either going to reassert the facts that you know, or it's going to fail to reflect the facts, and you're going to figure out that maybe it's not worth pursuing this hypothesis. Reflexivity has been strangely neglected in economic theory. By taking the demand-supply curves as given, economic theory can treat market prices as a mere reflection of the underlying fundamentals, i.e. supply, and the participants' preferences, i.e. demand. This leaves out of account the active, creative, and distortive effect of the participants' imperfect understanding. It gives a very misleading picture of financial markets. For instance, it implies that investors base their decisions on the fundamentals, whereas the goal of market participants is to make money, right? So that's huge, right? That's a huge difference in people who are just investing versus people who are day trading. And that's why the advice to just buy and hold for the long term tends to hold true, but you can make a lot more money a lot quicker if you have more efficient information, which he talks about, which we, just talked to, which he just showed the efficient market hypothesis is not true because of reflexivity, in his opinion, and that's kind of why he's saying it, because that's what he's going to try to show in this book. Only if market prices reflected the fundamentals accurately would it make sense for them to be guided by those fundamentals. And in that case, nobody could make more money than anybody else, and everybody ought to invest in index funds. This is an absurd conclusion, he says, yet it is still widely accepted. I didn't read ahead to that. I had that section starred, but that's kind of what it means, right? If the fundamentals were true of every stock, of every company, then everything, we would know everything, and there would be no reason to day trade or short stocks or anything like that. And so just an interesting He just points that out as a way to highlight what reflexivity is in practice. This next section is called the new paradigm. Instead of drawing dichotomies between thinking and reality, we must recognize that thinking forms part of reality instead of being separate from it. The dichotomy between thinking and reality is itself something that was not discovered, but rather invented by us in our attempt to understand reality. As such, it became part of reality and rendered reality more difficult to understand. In other words, reality always exceeds our capacity to understand it. Now that we have come to understand this point, we need to invent a new way of dealing with reality, or more exactly, that part of reality that has thinking participants. The next section is called the shoelace and Ziploc theories. I've highlighted just a few sentences. Outcomes are affected but not determined by expectations. There is a two-way feedback loop between them. The cognitive function runs from outcomes to expectations, but the participating function from expectations to outcomes. So you think it'll be a certain outcome. Then you participate, you go and buy the stock, you go and short the stock, you go do whatever you think, and then that turns back in to the outcome, to the thinking, right, of your expectation. And so that's what creates this reflexive process between the participants. And so that's what you have to take into account when investing, is what he is trying to show in this book. Both functions operate continuously and in the opposite direction. 3 paragraphs down, he starts out with, this way of looking at reality will be difficult to get used to because we have been conditioned to think differently. Understanding reality is the next section, in which a few paragraphs in, my highlight reads, this possibility poses a danger to scientific method, but it offers hope for mankind. The divergence between thinking and reality has emerged as an important factor in determining the course of events. Reality is full of flawed constructs. The fact that a certain way of thinking prevails does not mean that it is valid. It's very important. Like, even he saying that is pretty important to remember. The fact that an institution exists does not mean that it is well constructed. His next section is entitled Financial Markets as a Laboratory. I contended that the application of the concept of equilibrium to the financial markets is itself a misconception. It came about because of the success of natural science. Economic theory sought to mimic Newtonian physics. And this is what is like so important about what you learn in college and what is taught in college as far as economics is concerned versus how the markets actually operate, and why books that I've done already, like Keynes, Road to Serfdom, and I can't think of them right now. It's important to read those books by the economists who didn't study at university, because they kind of have more of a George Soros understanding of markets, of the economy, and say like, okay, so what they teach in school isn't quite what's really going on here. Let's take a further example. Keynes's theory, hold on. Friedman, Milton Friedman and Keynes. The distortion became more pronounced when credit was introduced into the analysis. Credit cannot be treated as if it were merely a passive reflection of the underlying fundamentals, since it also plays an active role in shaping the fundamentals. This can be seen when we consider the relationship between the act of lending and the value of the collateral. Banks base their lending on the value of the collateral, but the act of lending can also influence that value. When people are eager to borrow and the banks are willing to lend, the value of the collateral rises in a self-reinforcing manner and vice versa. Thus, the act of lending activates a reflexive relationship that is absent in pure exchange. The misconception in the recent technology boom was even more egregious. Investors value top-line revenue growth, disregarding that the business models could be sustained only as long as companies could sell stock at inflated prices. I think he's referencing the dot-com boom in the 2000s, because that's when he kind of did this book. He came back and went through it again to rewrite it. Not rewrite it entirely, but update it. In the absence of equilibrium, it is the task of the authorities to prevent or correct market excesses, but they too are fallible. Although they are supposed to be above the fray, they are also participants with their own institutional interests, and biases. The result is a reflexive interaction between regulators and markets, a kind of cat and mouse game which occasionally deteriorates into a boom and bust sequence due to the regulator's failure to prevent it from happening. I highlighted that paragraph because I thought that was so important, especially since he's kind of talking about 2000, right before 2008. So, one second. So, it's also important because of what he goes on later to say about that cat and mouse game between regulators and how that affects the financial markets, which hopefully we will elucidate when we get there. He goes on to say, I should have emphasized the role of flaws and misconceptions as a key to understanding historical developments. That is what I am doing now. My starting point is that financial transactions do not take place in a vacuum, in accordance with timelessly valid laws. There are actual laws and institutions at work that evolve over time and provide a historical context within which the timelessly valid generalizations operate. When we apply the timelessly valid concept of fallibility to the institutional framework, we arrive at the proposition that whatever regime or arrangement prevails, it is bound to be flawed. A couple of paragraphs later, I highlighted, it can be seen that whatever currency regime prevails, it is flawed. The fact that a regime is flawed makes its opposite more attractive, but that does not render its opposite flawless. The flaws will become apparent when the opposite regime prevails. This sounds discouraging, but it can also be interpreted in a positive way. Where there is infinite room for improvement, since perfection is unattainable, future generations will not be deprived of the opportunity to improve the world in which they live. He's hopeful. The fact that a thesis is flawed does not mean that we should not invest in it as long as other people believe in it and there is a large group of people left to be convinced. The point was made by John Maynard Keynes, when he compared the stock market to a beauty contest where the winner is not the most beautiful contestant, but the one with whom the greatest number of people consider beautiful. So that part is very important because that kind of illuminates the idea of reflexivity, because Soros says that reflexivity is caused by what we're told and conditioned to think. The market has thinking participants. They think they know the outcome, and then they act upon that, which creates more reflexive processes and other participants who then think, okay, that will be the outcome. But then you have people who think the opposite, and so they have a negative reflexive process, which kind of works in reverse, which creates this loop that he's talking about. So after he talks about John Maynard Keynes talking about the beauty contest metaphor, Soros says, I have something significant to add, pointing out that it pays to look for the flaws. If we find them, we are ahead of the game because we can limit our losses when the market also discovers what we already know. It is when we are unaware of what could go wrong that we have to worry. It hardly needs stressing that this approach is in contradiction with the efficient market hypothesis and the theory of rational expectations. The latter claims that the markets are always right. My proposition is that markets are almost always wrong, but they can often validate themselves, which I would agree with. I think that if you look at the markets, everything's overinflated. Inflation is part of that reflexive process because of the institutions that he was just talking about. But when you have so many people who don't know kind of what they're getting into and they're just doing it because, well, so and so made money in the stock market, so I'm going to get into the stock market, and then a big boom bust cycle happens, then that's when people lose money, and then they lose a lot of stuff and they call it, a gamble, and they don't understand it and it's not their fault, yada yada yada, when they should have just had more understanding going in. And what he's saying is that if you understand more than what the news media tells you, what the college degree economists are going to tell you, And if you kind of look at it from a human behavioral standpoint, you might be able to, I don't want to say he's trying to time the market, but he is saying that like you're going to be able to like, if you can kind of like intuit what people are thinking and the masses are thinking, then maybe you're going to be able to mitigate your losses. Okay, so he closes this section with a critical mode of thinking may be more of a hindrance than help. People do not like to hear when they are wrong, and they like to follow leaders who can convince them that they know what they are doing. Those who admit their mistakes or their doubts do not stay leaders very long. This may be one reason why markets are more efficient than politics. There is a difference between what is successful and what is true. Our society worships success as if it were combined with truth and virtue. This view, which is dominant in present-day America, is false. The next section is called The Search for Second Best Solutions. In their search for universally valid generalizations, economists largely ignored the complexities and uncertainties of the real world and constructed an elegant axiomatic structure based on unrealistic assumptions. The assumptions underlying perfect competition include perfect information, homogeneous commodities, a large number of participants engaged in profit maximizing behavior, and no transaction costs. The contention that unregulated financial markets lead to the optimum allocation of resources rests on the assumption that participants base their decisions on rational expectations. None of these assumptions prevail in the real world. So that he's saying that that's a lot of complex way of saying the efficient market hypothesis isn't true. There are no rational thinkers because in a perfect and efficient market, all of those things would be true. And there are transaction costs, there are hidden fees. Not everybody is doing profit maximizing behavior because there is tax loss harvesting, because there's all of these other little things that go on. And so there can be really no true efficient market. I see some merit in behavioral economics and even more merit in evolutionary game theory. I consider the lateral a practical exploration of reflexivity. He has a section on adaptive behavior next, which I have a couple of highlights. Reflexivity goes beyond the concept of adaptive human behavior. This means that participants have to adapt to constantly changing situations, and the process will never be complete. Equilibrium may never be reached because the attempt to reach it moves the target, which kind of makes sense if you have been a student of the game long enough. You're like, oh, okay, no wonder he did so well. Like, he was a student of the game. He came to notice this. He came to realize that what he was conditioned to think wasn't true about the markets, and so this is why he had the success that he had. Rational expectations theory could prevail only under conditions Rational expectations theory could prevail only under conditions so extreme as to be unsuitable for human habitation. By contrast, the theory of reflexivity does not provide the rigorous results we have come to expect from scientific theories, but it does fit the actual behavior of financial markets much better. There ought to be no contest. In his section on the boom-bust model, I've highlighted the main similarity lies in self-reinforcing processes whereby inflated stock prices can accelerate an underlying trend, which in turn enhances expectations and inflates stock prices until the outcomes fail to sustain expectations and there is a crash. Further down, starting in the middle of a two-part sentence, in the technology boom, the error was more egregious. Stocks were valued at a multiple of revenues, not earnings, and growth was financed by selling stock, not by following sound business plans. Expectations were inflated until they became unsustainable. So we see this a lot today, especially in the pump and dump penny stocks. We find a new company, a bunch of people online will pump it up. This is kind of what was it, The Wolf of Wall Street, I guess, Boiler Room, those movies that glorify it, of like he makes the call, he sells it, you're like, you're not going to want to miss this opportunity. Like this company is poised for this and that kind of growth, and it's going to go through the roof. And then there's a big rug pull. And so that's kind of what he's talking about here, is that the dot-com boom was kind of like that, but there were no underlying fundamentals. It was just hype and hype alone and good marketing. The professions, lawyers, accountants, auditors, security analysts, corporate officers, and bankers, allowed the pursuit of profit to take precedence over long-standing professional values. He's talking about GAAP. When broad principles are minutely codified, as they are in GAAP, generally accepted accounting principles, the rules paradoxically become easier to evade. A whole industry was born called structured finance, largely devoted to rule evasion. So here he is pointing out that there's a whole industry about evading the finance rules. Underlying this indiscriminate pursuit of financial success was a belief that the common interest is best served by allowing to pursue the narrow self-interest, or market fundamentalism for short. Market fundamentalism is a false and dangerous ideology, he writes. It is false on at least two counts. First, it profoundly misapprehends the way financial markets operate. It assumes that the markets tend toward an equilibrium that assures the optimum allocation of resources. Second, by equating private interest with the public interest, market fundamentalism endows the pursuit of self-interest with a moral quality. The second fallacy is even more dangerous than the first one. It accounts for the widespread abuses